Hola, buenas tardes a todos y muchas gracias por conectarse a este webinar organizado por el CFA Society de Chile. Mi nombre es Nicolás Fonseca y soy el responsable del área de distribución de activos tradicionales líquidos para Latinoamérica en HMC Capital. Para quienes no conozcan la firma, HPC Capital es una plataforma global de inversiones y distribución de activos tradicionales y alternativos. Fue fundada en 2009 y representamos gestores de clase mundial especializados en renta fija, renta variable y multiactivo, ofreciendo una amplia gama de oportunidades de inversiones globales. Operamos con presencia local en 6 países: Brasil, Chile, Colombia, Perú, México y Estados Unidos, con un equipo de 80 profesionales en Latinoamérica y Estados Unidos para clientes institucionales y privados. Contamos con un enfoque educacional único, ofreciendo acceso a capacitaciones, seminarios académicos y clases magistrales con expertos globales y en las mejores universidades del mundo. Ahora le paso la palabra a mi colega Joel Peña, quien presentará a nuestro speaker e introducirá el tema que trataremos hoy. Joel, por favor.
Muchas gracias, Nicolás, y gracias a la Sociedad CFA de Chile por organizar este webinar. Estamos encantados de participar en esta discusión. Mi nombre es Joel Peña, como mencionó Nicolás, y soy el responsable de DoubleLine para Latinoamérica y Canadá. Para quienes no nos conocen todavía, DoubleLine Capital es la firma de inversión fundada por Jeffrey Gundlach con base en Los Ángeles. La firma administra más de 135 mil millones de dólares en diferentes estrategias de inversión con un sesgo siempre a la renta fija. El día de hoy nos acompaña Jeffrey Sherman, CIO adjunto de la firma. Jeffrey es miembro del comité de inversión de DoubleLine y lidera el equipo de administración de portafolios multisector y estrategias de derivados. La presentación de hoy se enfocará en la inversión sistemática cuantitativa y los beneficios que ofrece a los inversores para mantenerse en curso. ¿Qué significa mantenerse en curso en este contexto? Creo que una frase de 1923 del autor Edwin Lefebvre sobre los riesgos de la psicología humana genera en los mercados puede ayudar. Él dijo que la esperanza y el miedo son aspectos inherentes a la naturaleza humana. Cuando los mercados se mueven de manera desfavorable, uno tiene cada día la esperanza de que este va a ser el último día y pierde más dinero del que hubiera perdido si uno hubiera tenido dicha esperanza. Y cuando los mercados se mueven de manera favorable, uno se vuelve temeroso de que el siguiente día puede perder los rendimientos acumulados y sale demasiado pronto. En este otro caso, el miedo limita la ganancia adicional que se pudo haber generado. De cómo un modelo sistemático cuantitativo puede prevenir este tipo de sesgo del comportamiento en el proceso de toma de decisiones de inversión es de lo que nos hablará Jeffrey Sherman. I will switch to English now. There will be a section at the end for Jeffrey Sherman to address questions. Please remember to submit your questions by emailing emgmt@chile.cfasociety.org. With that, I'll now pass it on to Jeffrey Sherman to start the presentation. Jeffrey?
Okay, well, thank you, Joel, and thanks everybody. Can you hear me? Am I on mute? No, I'm good, right? Hearing nothing, I'll go forward. Okay, thank you. Yeah, so what we want to talk about today is quantitative investing and really going back to the core principles that we've learned about through market efficiency and what people have called risk premia. So what I'm going to talk about today is belief in systematic strategies, how they can help investors kind of stay the course, especially when you have challenging market environments that if you believe in a process that seems to demonstrate statistically significant ways of increasing capital efficiency, then investors should be more apt to be able to weather the kind of uncertainty of various market storms like we just saw in the first quarter of 2020. So I'm going to move forward here. And what I've done here is I call this loosely smart beta. And the reason I use smart beta is to differentiate between systematic indexing versus, for instance, when we have committees that create things. So for instance, in the United States, we have the largest and most referenced index is called the S&P 500. A lot of people think that the S&P 500 is simply the 500 largest stocks based on market capitalization here in the US. However, they actually are not. It is a market capitalization weighted index, but at no given time is it actually based upon the 500 largest companies. It's based on various subjective criteria. And so when you think about a smart beta strategy or something that's systematic, you need to remove that human element from the decision-making process. And so loosely, the definition of things that are called smart beta, and again, this is a ubiquitous term, but it's very vague. I draw the parallels for, in the fixed income world, what people call the unconstrained strategies. That it tells you a lot, but it doesn't tell you much. So smart beta has loosely been defined as a passive portfolio weighting scheme. So it can rebalance, it can do different things, but again, there's no subjectivity in the decision-making process, and so that's very important. And it's one that's broke the linkage between price. And so that would be the definition that research affiliates would use to think about it. And so I know folks down in Chile are familiar with Rob Arnott and his firm at Research Affiliates. And so I do like, the tongue-in-cheek aspect that comes from Cliff Asness and his firm, Applied Quantitative Research, or AQR. He's called it a smart beta as a relabeling of factor investing. And I completely agree with that. Factors or just smart beta in general tends to capitalize on factors. When I went to school roughly 20 years ago or so, when I was in graduate school, we used to call these anomalies, because when we were taught finance, what we were taught is that the efficient market rules everything. And obviously one can't be an investor that in an actively managed product if you believe in market efficiency. And so the parlance at the time was definitely called anomalies. We have really called them factors because they could be quantitatively defined. And so you could think of them as a factor. Again, using folks that are tongue-in-cheek, at GMO, there's a gentleman by the name of James Montier there who is called smart beta as dumb beta plus smart marketing. So you kind of see the play on the words in English there. The smart goes to marketing, the dumb goes to the beta side. So again, not having an opinion there, I think as long as you understand what the objective of the portfolio is trying to deliver, I think that it can be called smart beta, it can be called anomaly extraction, it can be called factor investing. So using our friends at Research Affiliates to use the definition here, as they're roughly, I think it's about 60 miles from our headquarters in Los Angeles down in Newport Beach, they gave multiple attributes besides just the break of market capitalization. And so transparency is important. And so the transparency comes to the decision-making process or the rules that sit behind these things. As you see, the second state is rules-based methodologies. But they also want to talk about a priori. So before one investment, what should you expect from excess return sources? They believe it should be lower cost relative to active management. So notice here, it doesn't say it should be free because again, there's intellectual property in here. So there is work that goes in these strategies. So it should be lower cost than true managers who search for true alpha when it comes to alpha based upon security selection. Remember here, what we'll show is that, what I'll try to show is that some strategies out there generate alpha in the traditional sense when we control for factors. There should be large capacity. So you shouldn't think about a strategy that can only hold roughly 100 million US or so. So what you want is large capacity and liquidity. So remember that once you execute the strategy, the alpha should not diminish. And lastly, I think this is a little self-serving from Research Affiliates, but I like it as well, so I included it. And I say it's self-serving because of the way they construct some of their methodologies, but it's well diversified and or span the macro economy. And so the idea is that you're still trying to capitalize on not something that is truly just anomalous, but somehow has some linkage to the overall economy. So I'll use interchangeably, I'll use risk premia, smart beta, risk factors throughout this presentation, but I'd like to take you on a historical construct to really take you back through history and why we got to where we are today. And so I show here on page 2, I call it the evolution of beta, and I pose the question to the audience, when did it become smart? There's always been beta in the marketplace since the inception of the phrase. But I think if you really want to go back to it, you've got to go back to the father of modern portfolio theory, who's Henry Markowitz. And so back in 1952, Mr. Markowitz put together a paper that talked about optimizing portfolios and using some return and risk framework. And so he used variance at the portfolio level to ascertain what he ends up calling an efficient frontier. And then Sharpe came through about 12 years later. Professor Sharpe also won a Nobel Prize in addition to Henry Markowitz. And he wrote a paper called Market Risk, where they actually introduced the term beta. And so when you think about beta, beta comes from the nomenclature from Professor Bill Sharpe from Stanford when he wrote this paper, Market Risk. These are very challenging papers to read these days because there's inverted nomenclature. I'll show you in some of the graphics too. But these are really the key principles we started. Then in '68, someone by the name of Jensen came through and said, okay, let's define what he was starting to look at is, does the Sharpe portfolio and the market efficient portfolio and the beta, does that actually tease out from empirical data? And so what Jensen discovered was that markets don't appear to be efficient, or at least portfolios that are sampled from securities within the market do not appear to be efficient. And he coined this residual term, again, coming from the regression models. I'll show this all in a little bit, as alpha. Next came in Black, Jensen, and Scholes. You may have heard of those folks. Fisher Black and Myron Scholes were the two that did receive the Nobel Prize as well. They received it for a lot of their work in finance, including the option pricing model, and that's what the name's attributed to. But low volatility, again, this was trying to stress the idea there's a low volatility anomaly or the low volatility factor, and this came from the idea that based on market efficiency, that if there was a direct relationship between risk and return, so if return was only predicated upon how much risk one takes, there would be no alpha, as Jensen said, but also they showed that portfolios that focus on lower volatility assets tend to generate above average return control to that volatility point. That is, they have higher capital efficiency or higher Sharpe ratios. So the literature is obviously littered with more things out there, but I think really the next seminal, at least from my viewpoint, seminal piece that came out was Fama and French. And they introduced, in addition to the market risk, they come up with what they call the three-factor model, which includes the capitalization bias, small versus large, as well as the value bias, value securities versus growth securities. And so this became the cornerstone of thinking about value investing, although it's been used for many, many years. It harkens all the way back to Graham and Dodd when you think about their book in '33 called Security Analysis, but this was a way of quantitative looking at factors in the marketplace. Shortly thereafter, or probably contemporaneously, just a publishing issue, Jagadish and Titman are credited with finding the momentum factor. And momentum is one that flies in the face of the efficient market theorists because it does not really have a rooting within the academic framework of thinking about why there should be some momentum premium out there. If the market was truly efficient, it would get ahead of it, and therefore momentum shouldn't work. Some people attribute this to Mr. Asness as well, the founder of AQR, as he wrote his thesis piece on momentum. And remember, his advisor was Eugene Fama. I'll take you through a nice little history lesson here. But Eugene Fama was his advisor, who was a huge, out of the University of Chicago, efficient market pundit, as well as, from the Fama French model. And so Mr. Fama rejected the idea, but he allowed Cliff or Mr. Asness to go ahead and print that paper. So some people will call it, they'll call it Asness momentum. Yet Jagadish and Titman are typically credited academically as the first finders of it. And you'll hear some of it from Mr. Asness' partners when he's at Goldman Sachs and they run the Pure Alpha portfolio. Some of those other folks are attributed with it as well. So we did see some innovation in the 2000s from two gentlemen by the name, or three gentlemen, Novi Marks, Chen, and Zhang, that they came up with an alternative three-factor model. It's a kind of tweak on the Fama French model. It doesn't really add a lot to there, but some people are really focused on it. And so seeing that, also what we did find is an expansion of these factors. The folks at AQR, Cliff Asness, Frazzini, as well as Jacques Peterson, or that's not Jacques Peterson, sorry, it's Peterson, they came up with the quality minus junk. So this is something about look at the quality of companies. So quality was something that Novi Marks kind of looked at as well. They asked this Frazzini Peterson piece, had this QMJ factor. And then also Fama French seemed to get a little bit of envy out there that people are getting their model. And they came up with another 5-factor model that does some of these kind of tweaks about quality and light. They still don't introduce momentum into it, but they do have something that kind of looks like that low volatility. I do put it here at the very end of this timeline, Frazzini and Peterson, once again, the betting against beta. It is a play off of the low volatility, but it's nomenclature that I'll use in this presentation, so I gave them a shout out as well. So moving on to this, again, this is going to be a little historical lesson before we go into things. If you recall what I said about Markowitz, the paper is very difficult to follow because of the nomenclature. And so the idea behind the Markowitz paper, and again, just to distill it down to 2 graphics here, what he shows is the universe of all assets of all E and V combinations. E is expected return and V is the variance. But notice the horizontal axis, that is the one that goes across your screen, shows the expected return. The variance is on the vertical axis. So this is inverted from the way we think about it today. And so as an extension, you can see that the efficient frontier is inverted to the way your normal way of thinking about this. So it should be upward sloping to the right. It should look like this from your perspective. But again, just given its expected return on the horizontal axis and the variance on the vertical axis, that's why that looks a little bit different. But this is the efficient frontier and mean variance optimization that you know. So you always want to get a portfolio that dominates the efficient frontier. That is, it has the highest level of expected return per unit of variance. I'm sorry, for a given level of variance, or it has the least amount of variance for a minimum required expected rate of return. So moving along, just along my timeline, you can see here, as I mentioned, Bill Sharpe, and when Bill Sharpe put together the equity risk premium, this is what it started to be colloquially thought of as. Notice again that Mr. Sharpe has the same historical construct here, where you have the expected rate of return on the horizontal axis and risk on the vertical axis. And so this looks a little bit different from what we're used to seeing. But now what the key takeaway there was, one, you have the alpha beta separation theorem, right? Where you can the separation theorem, where what you can find is the portfolio which is tangent to that efficient frontier. So going back in this case, so if you look along here, what Professor Sharpe did was he said, okay, given the risk-free rate, and this is the separation theorem, that you can take any combination of assets that if you always want to own something on the most tangent point of the portfolio, and given a level of risk, you can dial, if you want to take less risk, you can dial that down by allocating some of the risk-free rate. And if you want more risk, you can leverage up and go out the frontier. And so that's exactly what he's trying to show here, that you're finding all these portfolios. In this instance, F is the portfolio, that is the tangent portfolio, and then you'd plot that to the risk-free rate, and it would go something in this direction. And so mathematically, we write this as we see at the bottom. It's simply a regression equation. The expected return on any asset. So notice that there's that J there to denote that's a specific asset. The asset can be an asset. It could be a portfolio. But again, capital asset pricing model works for any asset. And it's a function of the risk-free rate plus how much beta or market exposure you want. And so that's the expected return of the market portfolio less the risk-free rate. That market portfolio is going to be the tangent point along the efficient frontier, and you draw the regression line based on that risk-free rate of return that I'm circling right here. So again, we've all seen this in our CFA curriculum, but again, just to remind you. So now, what did Jensen really add here? So notice if we come back here, everything in this space is done on an expectation basis. However, when we go to Jensen, what he's saying is, okay, when I aggregate all these results at the portfolio level, what I see is that I don't see the efficient market hypothesis playing out. So Jensen did this on a bunch of mutual funds over roughly a 20-year period. And when he looked at those portfolios, what he found was that this relationship did not completely hold without adding this residual term in. So what this says here is that the excess return of a portfolio, that is, excess return is defined as the portfolio return or any asset return less the risk-free rate of return, because if it did not have a return above the risk-free rate, you would not want to pursue it. So it's excess return, and that's done in the regression framework. So all you do is, again, going to ordinary least squares regression, you calculate this portfolio's exposure to the overall market. Notice the risk-free rate is subtracted again here, right? So you have to do this when you do regression. Whenever you're calculating these metrics, you got to always do it in the excess return space. Otherwise, you have collinearity across it. And then what you find is that the beta is the beta or how much market risk you have. So once you find that, then what we'll tease out from that equation is the alpha component. And then there's always going to be some error term associated with that. So what Jensen focused on was saying that there seems to be a violation of the efficient market hypothesis, at least when looking at mutual fund data over that 20-year span post-World War II. So again, this is the framework we think about when we think about managers. This is something that we focus on. We call it Jensen's alpha still today. And Jensen's alpha is just saying how much value did that portfolio add when adjusting for the market risk. Now, again, what you have to make sure you have here is, one, you have to have a good specified model. So for instance, if one took the Barclays US Aggregate Index and regressed it on the market variable being the S&P 500, what you'd see is you get a very low beta, and therefore it would jam a lot into the alpha. So what you can do is look at goodness of fit. You want to have a high R squared in the relationship. You want a well-specified model, that way that your value added term is not misspecified. So there's ways to do that, to check that. You don't have to just use the R squared. You can do what's called the residual risk of the overall equation. So notice this error term. So I do my regression over many periods. It gives me an alpha and a beta. And then from there, I can use that average alpha and that estimated beta to figure out what that return is. And each of those error terms, I can see how good the model fits. And then I can create the standard deviation of those error terms. And that gives me how much residual risk I have in the equation. You'll see I'll use this later on. All right, so again, that's the basics of, that's the statistical refresher we'll give you today. Now what we're gonna focus on here is looking at various risk premium. So what happened with the Fama-French model is that in addition, so this looks just like Jensen's equation, right? We start off with the portfolio return less the risk-free return, right? We still have this catch-all term, this alpha in here, right? But notice that my beta now, I have different betas. I call it beta 3 for the market, right? Because it's just my 3-factor model. That's why I call it beta 3. So I have a market estimator. Then over each period, I have a size estimator. So beta S, this is SMB. This is the size factor, small minus big. So that's, again, using factor analysis. You create, you either create like deciles, quintiles, quartiles, whatever one wants to do. Typically, they work best with deciles. And you say the highest in size will be the largest market cap, and the smallest will be the smallest. So they take the small returns less the big returns and call that the size premium. The same thing can be done from evaluation. When Fama-French did this, what they found is that they used book to sales or book to price at the time instead of price to book. Kind of the whole world was inverted to what we know these days. So again, when it's high minus low, that means a high book to price or something cheap or value versus a low book to price, which is a growthy type of stock. So this created a new framework to thinking about, okay, what they found is that there is some return to the size premium over time. There's some return to this valuation premium over time. And so again, this allowed, I believe, Mr. Fama to come back and say, you know, this is why I still believe the markets are efficient. There just has to be something in these other metrics. So any type of alpha you may have seen from this perspective that Jensen did, what happened is Fama-French, sorry, I hit the button too much. Fama-French were trying to explain it away with size and valuation. Now that we all know about these, we know the efficiency you can create these portfolios. Some of these have been kind of arbitrage or turned into factors in the marketplace. So as I mentioned with Jagadish and Titman, they showed momentum. Again, remember, as you do regression, the goal is to have, if you're going to introduce more variables, they need to be orthogonal to one another. So again, you don't want to have overlap of the factors, but momentum seemed to increase the explanatory power of the regression as well. So now notice here I use beta 4 over here. This is a different beta estimator based on my market, but I simultaneously estimate all the factors from each of these positions as well. So now we have market size, valuation, momentum. And this is really known these days as really the key main factors out there in the marketplace today. So again, these tend to generate an ex post risk premium. So that's interesting when you think about it, that again, this is more and more trying to explain that, well, everything is just some form of factor, that there really is no residual return out there. There's no incremental return. This is just saying the market's efficient. It's some variation of market size, valuation, and momentum. So again, as I said, I think Fama-French had some envy here. Notice that they create a 5-year, a 5-factor portfolio. So now my beta, once again, is a beta 5 to differentiate this. They still use their size and valuation. Notice that they don't introduce momentum here, but they bring in profitability as well as investment. And this is what this is the profitability is essentially thinking about, the return on equity and how that looks. Again, so high profitability companies versus low profitabilities. For right now, for some reason, the R and the W is escaping me. But you can look at the investment. This is how you invest, and it's kind of like a function of leverage on there. Are you conservative minus aggressive? And so this explains stock returns. Increase the R squared a little bit. These are a lot harder to look at because investment tends to be related to valuation, and sometimes profitability does. Investment does have some correlation to size as well. So although this has been put out there, it hasn't really gained a lot of acceptance like their three-factor model did because of some of that overlap, which creates collinearity across these because you need orthogonal independent variables. That's the whole thing when you do regression is, remember, independence, but it's independent. The more you add in there, then they have to have orthogonality in all the dimensions. So moving on. So, and I call this a more intuitive model. That's my own preference here. And this is combining the three pieces here, the low vol premium, the betting against beta. Those are very similar. I like the jargon of betting against beta. It just sounds a lot better, rolls off the tongue better. And then quality minus junk. And so using this model, what you can see here is that when you start to look at is that when you have the six-factor model here, again, so now the beta 6 is for the market. We still have size and valuation defined very similarly. And again, there's no steadfast rule when you're talking about valuation. People can use price to sales. You can use price to book, price to revenue. You can use metrics that you want to use there. There's nothing that says you have to use any single one of them. And what you'll find is a lot of folks that do factor work combine multiple measures of valuation to construct these variables. Low volatility, it tends to be assets that have exhibited either a low beta to the market, again, assuming that you have a well-specified model, or exhibited low volatility over some measurement period. And typically this is over like a 12-month period. So low risk relative to high risk securities. You would think that some of that has to do with valuation, but you find that, again, just given the diversity of the asset mix, when you look at all the stocks in the US market, it works quite well. Quality, this is quality minus junk. So this is, again, assessing the amount of leverage that's in the company, trying to look at profitability, that they're well managed. They're still using, there's no qualitative variables that go into this, and it needs to be quantitative in nature, at least something you can calculate from there. And then lastly, the momentum factor typically is defined as 12-month momentum. Again, people use different periods to look at that. So what I'm going to use is this model here to say, okay, we know there's a lot of systematic strategies out there. Let's take a look at what's off the shelf available. It's available in some sort of wrapper in the US. So it's an ETF, it's an index that someone can replicate out there through a mutual fund, or it's something that's off the shelf available to investors that has a significant time frame so we can look at it. So we don't want to just look at something with a 2-year or a 3-year, something just heavily back tested, doesn't exist. We want to look at things that have assets in them and definitely have a track record, at least a time series long enough going back that we can look at it. So what we'll look at first before we do that is what I want to look at is the factors themselves. So if you look at the factors themselves, and what I'd like to do is obscure this table. Unfortunately, I have it in here. Just look at the charts here. I like to show this to people when people tell me they know a lot about factor work, and I say, okay, here's the factors going back to 57. It's like the post-World War II era, and it's really where Frazzini and Peterson's database goes through. And I ask people, of all these factors up here, which one is this top line? And typically what you'll hear from folks is they'll say it's the market. They've been indoctrinated with this idea that the best performing thing is the market because of efficient markets. However, this is not. This is actually the low volatility factor that has generated the strongest rate of return. Again, it's on a logarithmic scale you can see over here. It's generated the highest rate of return over this period of time. It's had a lot of volatility, right? And you can see that from here in this the Sharpe ratio. I'm using the arithmetic excess return relative to the T-bill return. These are done in excess return space, so I don't need a T-bill. So I divide by volatility, and I get the Sharpe ratio there. So not only has it been a high return, it's been the most capital efficient of all of these. What's interesting, though, as well, is that momentum's been challenged for the last few weeks in the US. And unfortunately, data sets weren't updated quick enough for me through May, for me to introduce that into this presentation today. But you can see here that momentum has been a very, very strong performer. So these anomalies or these factors or things that are not predicated upon efficient markets, but actually on human behavior, I would argue. Why does momentum persist? People like to buy winners. They like to buy things that continue to go up. They sell losers. If things are, if a stock is a dog, they tend to sell it, or they don't want to buy into it. So that momentum feeds itself. Also, remember, market cap weighted indices tend to be momentum beasts because the largest stocks, if they outperform, they tend to become larger and larger as well. So the best performing stocks get better weights. So inherently, market cap indices actually are a way of looking at momentum, although it is segmented here. But notice here that Mr. Market, MKT, is only the third best performer in the US. So again, it's not a bad return. We're talking about a geometric base, about 5.25% return per annum. But notice it has half the Sharpe ratio that low volatility has, and about 2/3 of the Sharpe ratio that momentum has. So no wonder there's been this fever of people trying to introduce products that want to capitalize on the momentum factor, also on the low volatility factor as well, because the low volatility has done significantly better than the market with less risk. And you go down here, you'll see the next best performer here is quality minus junk. Again, that makes sense. Investors do crave better quality companies. They tend to survive better. But notice here what's happened in this gray line here. The value premium has been massively out of favor for the last few years. It has generated a long-term rate of return. You see here that it's about a 220 per annum rate of return, which isn't bad. That's better than you can get in the treasury market in the US today. But again, it's been significantly out of favor, as you can see in this post-global financial crisis era. And again, the long-term return peaked right before the global financial crisis, and a lot of that has to do with the financial industry. So notice also, one that people really think highly of is small cap. And notice small cap is the worst performing factor, albeit positive. With a Sharpe ratio that low, it doesn't give you a lot of statistical significance. But notice here, you really haven't made money in roughly almost 40 years in small cap. So yes, if you timed it, at the end of the tech bubble down here, you would be up. But notice here that once this small cap premium was written about, it tended to go away, and a lot is because more and more capital are going at the smaller and smaller assets. So whereas momentum can be capitalized on market cap weighted indices, small cap, you have a problem that as you add more and more money to the space, it bids up the price of those assets, and they tend to not be defined as small cap anymore, or they end up collapsing. So it's an interesting tidbit on the factors. But the idea, if we're going to put together a portfolio, is that we want to have things that are somewhat uncorrelated. Remember, I talked about orthogonality of the regression equation. So what we want, if we're going to use this to explain it, we want to make sure these exhibit relatively low correlation and thus have the property of orthogonality. And you can see here when I look at the correlation matrix that they're relatively low numbers. So what you see, there's not a lot of cross correlation. The highest cross correlation seems to come here between the low volatility and the value factor, which is strange because value tends to be a pretty volatile factor. But again, that's just what you observe from this. So the average cost correlation is low. And so what you could do as an investor is to say, okay, is value going to work? Is momentum going to work? Is, so the small cap premium going to work? What you could do is create a portfolio of each one of these. And so notice here, what we've done now is we create an equally weighted portfolio of various factors at this stage. Okay, so what I've done here is I've taken 3 sets of portfolios and compared them to the market portfolio. What I've done is I've taken an equally weighted portfolio. Okay, this equally weighted portfolio only uses the Fama-French factors. Notice here there's no market in here because the market gives me a correlation to the market of 1. It gives me market beta. I can get that cheap and easy, right? I can get it for free practically in the US. So what I can see here is I take 1/3 to the Fama-French plus momentum factors, and I do this in a 1/3 weight. And I believe in this instance, I rebalance them on a monthly basis, okay? And so that'll incur some transaction costs. If you do it quarterly, you don't really get much different here. But again, that's what we've done here. Notice here that the market has a Sharpe ratio of 0.4, but when we look at this equally weighted portfolio across these 3 factors, you get a Sharpe ratio of 0.75. And you can see this too, that the experience is much smoother for the investor. Now, what happens if I introduce the low volatility premium? So we can introduce the low volatility in here. And so now I'm going to take 25% in each of the 4 factors, create that portfolio each month, reconstitute. Notice that I get a higher capital efficiency again, right? So nicely, right? Even though, so it adds a little bit of return from buying this low volatility factors we saw as the best performer. But what it also does is it slightly increases the standard deviation, but it does so in a manner that you still increase your Sharpe ratio. And then what we can also introduce is quality minus junk here. So it lowers the return, albeit ever so slightly, but you get a nice reduction in volatility. Remember here, the idea is capital efficiency. So what you could do here, notice here that for every unit of volatility, you're getting 1.1% return on those assets. So it is quite interesting to see here that this portfolio does just as well as Mr. Market or Mrs. Market without introducing any really market risk. And notice how much smoother these experiences are. So yes, there will be periods where these portfolios underperform. I'm doing this from a long-term perspective here. But the good thing about these is that they're all in excess return space. And because you can go get market beta from the futures market, you can pull these things together. So now when I think about this, these 3 portfolios I just made here, these equally weighted portfolios, what I want to make sure is that they're not delivering market beta. So I go back and check my correlation. And so you'll see that they have slight negative correlation to the overall market. Obviously, by construction, they're going to have relatively decent correlation with each other because there's significant overlap. There's 33% here, there's 25% of the portfolio here. So there's a lot of, there is a lot of inherent correlation because of that. But in general, what you find is that they are uncorrelated to the market. So as I mentioned, there's one way of taking these factors and then just putting market beta on top of them. You can do it cheap and easy via the futures market. And so therefore, you can still get the market-based returns plus this risk premium. So what you want to do is, again, as I talked about earlier, so I find this very interesting that, again, these factors continue to deliver even though we all know about them. They're widely publicized. They work in multiple markets. I just have a long data set in the US, but you can see they work for global markets. They work for the emerging market world. They tend to work pretty well across many portfolios. And one of the most pervasive happens to be momentum, as well as low volatility markets, as investors don't, they shun leverage, and therefore they wanted to get those high return expectations. What they end up doing is going into these higher risk segments. So let's say you're shopping for a solution, right? And so what you want to find here is you want to find some solution that gives this to you package. And so what we want to do is mitigate execution costs, turnover, let's add the no short selling, access to leverage. So what we can find is we can find things that don't explicitly build these portfolios, but do have exposure to these factors just based upon their construction. And so again, as I mentioned earlier, what we're going to look at is a suite of these things as well with the market overlay. So notice here now, if I take the market overlay and I do this over a common time period because I use some other indices in there, what you see is that over this period, the equally weighted portfolio with the market has generated an above market return. It's done so and also reduced the risk because of that correlation there. So even though these portfolios were not as strong in performance over this period of time, when you couple them with the market, they do give you an incremental alpha source. And so I've been promising this slide. I thought it was sooner than later. But what we did is we took some indices out there that meet various criteria. That criteria is that it needed to have a 20-year history, that it needed to have a significant amount of capital in it, at least over the last few years. And let's take a look at how the performance of these various strategies would work, and they need to have a deliverable out there. And so these are various indices that are available. There's something called the Shiller Barclays CAPE US Sector Total Return Index. That's a value strategy that does sector rotation. There's the equally weighted S&P, so that's going to have a small cap bias, right? It equally weights each of the 500 companies. There's the low volatility of the S&P 500, so it's trying to capture that low vol premium. There's the RAFI 1000, which again, from research affiliates, where they have tilts using their criteria to a value type of portfolio, and a little bit of the capitalization. We have the Russell 1000 equal weight. So now, instead of 500 securities, we're using 1,000 securities equally weighting them. We have this diversified multi-factor index as built by the MSCI. And lastly, the S&P 500. So notice here that they all seem to behave, they seem to wiggle and jiggle together, meaning that what they have is market risk. They have US large cap market risk, and you can see that they zig and zag roughly in a similar manner. However, what you do find, they have different risk profiles. The lowest, the lowest being the S&P low volatility. That's good. If you're buying low volatility, you want to behave that way. Then you see that the Shiller Barclays cave is about 19, which is in line with the diversified portfolios of the S&P as well as the diversified factor. Notice these equally weighted portfolios, because you introduce a little more mid to small cap bias in there, or at least SMID type or mid type of exposure, it'll end up giving you a higher rate of return. Someone's writing on my screen somehow. I don't know who you are, but I think you're creating an efficient frontier for me, so thank you. And then lastly, you see here, the FTSE RAFI just looks like another value strategy as well. So my frontier is going to keep going on, but let's take a look at what these factor exposures look like. And so what we can do here now is take each of these indices that I showed, again, based on that criteria, the 20-year history, a significant amount of assets, and deliverable to a client in a cheap format. And let's calculate their in-sample factor exposure to that 6-factor model. And I disclose that up above here. I'm using market, small minus big, high minus low, beta against beta, quality minus junk, up minus down 6-factor model. And notice here, so let's start with the S&P. So the S&P has a market beta of 1. That's what I would expect. Size, small minus big, it has a bias. It's a negative sign. It's a large cap portfolio by definition. It has a small exposure to value here, although value at 0.01, it's not really that significant. So it's high minus low, so that would be a value. Betting against beta has really a non-zero coefficient when we look at the standard error of these things. It does have a quality bias in it. The momentum is nil because that's not part of it, so you'd expect that. And I'm calculating all the metrics relative there, so it doesn't have any residual risk or an info ratio. So let's talk about things that people know about. So let's look at the Russell 1000. So the Russell 1000 seems to have an intercept here. It has an alpha once we take a look at it. So it's an alpha of 1.7% after controlling for these known risk premia. So you can see, but it has market risk. That's good. The size, it tends to be more mid to SMID weighted. So you are making a bet there. So you have to be cognizant of that. If you're looking for large cap, Russell 1000 is not giving you that. That maybe is some of the return you see here. It does have a little bit of the low volatility premium in it, right? Because again, just having more assets here, and again, being equally weighted, you're going to have a heavier tilt to smaller assets. It does have a junkier portfolio that you expect with some of the small cap. Momentum, it is a value strategy, therefore it does have a negative momentum here. So it's kind of a mean reversion strategy, and has about 2.7 of residual risk. So the alpha divided by the residual risk is what I call the info ratio. This is how good and how pervasive is your alpha here. So looks pretty good, just need to know what bets you're taking. Look at the diversified multi-factor. It gives me exposure to the market, gives me exposure to size that I expect, and to value as I expect, to low vol, gives me quality minus junk, and it gives me momentum, right? But notice once you explain it all, it has no alpha, right? So it gives you exactly what it tells you. There is no incremental return here. So I'll give kudos to MSCI for building this. It gives you exactly what one would expect, exposure to here. But once you look at the returns and you regress the returns, there is no incremental return source. So the Russell 1000 equal weight seems to have some other incremental return. My belief and my contention is that's due to the rebalancing effect of that index. And that's what's driving this incremental return. Rebalancing, especially in volatile markets, can generate incremental excess return. Now looking here at the S&P 500, very similar to the Russell 1000, it's the S&P 500 equal weight. Notice here you still have above market beta because you have riskier stocks because you're small cap. You're going to have a little more value. Very similar here. It's just you get a higher kind of residual return. It's not statistically significant if you did in a T-stat, but the Russell 1000 is. And so low information ratio. So what it's doing, it's extracting some of these premia, but it's not giving you any incremental return source. So I have nothing wrong with going and extracting premia, but if I could extract the premia and get an incremental return source, perhaps that's a better purpose. And then lastly, on the first column here, we see the Shiller Barclays Index. It gives you the market exposure. It's a sector rotation and large cap, so it gives you that large cap exposure. There's no small cap bias in here. It does slightly tilt to value. You can see that from the momentum factor here as well. The betting against beta does not have exposure to low volatility, but it does have a higher quality portfolio. And so that's probably because of using that CAPE ratio to ascertain that. It does have higher residual risk than everything but the low volatility portfolio, but outside of the Russell 1000, it does have the highest info ratios of this residual return. This residual return is capitalizing on two things, I believe. Again, it's that rebalancing of the portfolio that's done on a monthly basis, as well as also the people shun sectors of the market just like they shun stocks. So again, looking at the statistics here, another thing to look at, again, this frontier is kind of in the way, whoever drew that for me, but you'll see here that they all have, you know, you got to take some of the pain along the way. There's a lot of drawdown out here, but if you go back into the univariate regression model, where we just do correlation to the S&P, we do alpha, you'll see that the largest alpha here in this simple one-factor model now, because we're using the sectors of the S&P, notice that it has one of the highest out there. It has high correlation to the S&P. The beta is a little bit lower because remember, beta is the correlation times the ratio of the volatilities. And so you can see that there's a reason that we have a bias towards this index. So there's drawdown. So lastly, I guess another way to think about risk. So a lot of people think about volatility or variance using the Markowitz framework. Another way that I like to think about risk and frame it is drawdown. Because at the end of the day, you have to be able to stay in the trade. That's what I was talking about at the beginning, you know, helping investors stay the course. If you can mitigate some of those drawdowns, that can be helpful. So what I show here, instead of using variance or standard deviation on this chart on the vertical, I'm sorry, on the horizontal axis, what we do is we do the peak to trough drawdown. And you can see here, and again, some of this, we added another phrase up top, but this is the long-term drawdown. What we also did is we showed what the drawdown was in its most recent COVID-19 panic. And you'll see here that a lot of these other factor indices, like the equally weighted portfolios, were the worst drawdowns. You know, I'll also argue, being a practitioner, that being down 34% or being down 39%, it still stinks. We all know that. It's no fun being down that much, but every percent we cannot lose can be helpful as we think about it too. But notice here, if you created this framework of thinking about, you know, return relative to the overall peak to trough drawdown, it may elucidate another decision making as well. So that's why I do like these type of portfolios over here. So I think what I'm showing here is there's nothing new under the sun. What we now call risk premium today has always been factor investing. Those were called anomalies before. We call it smart beta sometimes. This is more accepted in the parlance. Risk premia, you're using Greek terms here. People don't know how to pluralize premium. A lot of people call them risk premias, or premiums, I should say, but it's risk premia. It's all the same stuff. So you've seen it in different flavors. You've heard about it. And there's really nothing new out here. What's changed is our access to technology, the access to large data sets, the ability for anyone with an internet account and access to a spreadsheet can create their own factor portfolios. And so what's happened is this has exposed some of the quant strategies out there, that the quant strategies that were charging high fees for perception of alpha were really just capitalizing a lot on various factors which appear to be uncorrelated to the market. So lastly, so what I want to talk about, I think hopefully what you gathered here is, one, it's a little history lesson, but these smart beta strategies, risk premia, factor investing, whatever you want to call it, they're the natural evolution of the findings out there, both academic and empirical. We've seen a lot of things arise in the empirical space. There was a gentleman out of the Duke Fuqua School, his name is Campbell Harvey. He wrote a paper called something about the factor zoo, that if you look at all the academic research, there's over like 600 factors that have been published out there. A lot of them are redundant. A lot of them are just fit to a specific time series. So you need to have an academic thesis, I'd argue, on why your factors should work. You should do that a priori, not after you've data mined it. You should be able to empirically test it. And then further to that, you need to be able to test it out of sample. And that's what we're trying to show with these various indices, how they perform out of sample after being created. So again, not all of the smart beta is equal. Sometimes there's other parts of return in there. Know what you're looking for. So it's a classic caveat emptor, buyer beware. Make sure you know what's driving it and make sure that's what you want in your portfolio. Remember, the goal is to get any uncorrelated return source we can find. Also, when going from academia to the practitioner world, make sure that you focus on liquidity and capacity. Liquidity is a function of bid-offer spread as well, making sure that you can transact in these assets and make sure that your asset base is not going to drive that alpha or that incremental return away. So that's very, very important as you develop this stuff. And I think that's why small cap has suffered in the US over the last 30 years or so, is because there's been so much discussion about it that people have thrown capital at it. So remember, turnover and trading costs are important. If you're going to execute this, you need to have a big trading desk. You need to outsource it to folks that have large books of business that you can become part of their overall book in there for those trading costs. So the alpha here is shown in these things. Again, if you're using index data, there's no crossing a bid-offer spread. It's important there. So I think there's something I want you to take away from this is that, one, smart beta strategy, regardless if it's marketing gimmick or not, are here to stay. They're here because they are exploiting other parts of the market out there. And the good news about factor investing is that just like I did back here on slide 17, as I did a risk decomposition across these things, you can do this for any active manager as well. So you can find out if a manager's alpha that appears in a single variable or univariate regression model, if that truly is alpha, or is it some exploitation of these various factors. So again, that may not be part of their process, but again, if you can do it cheaper, that's the goal, because we know that fees are a drag on the portfolio. And I do think that the future of smart beta strategies will apply across multiple asset classes. So there's things that can be done in fixed income. Fixed income is more difficult because for any single company, there's multiple issues. They can have different tenors, different currencies. They have different characteristics. And so, and the transaction costs are higher in the fixed income market. So it's not as simple out there. There are definitely smart beta strategies or smart factor strategies in the commodity space, in the FX space. And we are big fans of that at DoubleLine. So with that, I know I've taken about 50 minutes of your time. We'll open up to any questions that people have. And if you need to go over for a few minutes to ask questions, I'm happy to stay for, let's say, an extra 10 minutes or so. So Joel, I see you popping back on the screen. Can you take it away with any questions you've received?
Sure thing. Well, thank you. Thank you, Jeffrey, for this discussion. And we have a few questions here. One of them says, what type of market, and then in parentheses, geographic or asset class, does this approach work best? And in which one does it work worst? What about market conditions?
Sure. So you would expect that, you know, again, nothing's going to work in every market as we showed back there. So I think one of the best things to think about is going back into the presentation. You guys can still see my screen? Do you still see my screen, Joel?
Yes.
Okay. So let's go back here to this slide. So if you want to know what conditions and what markets these work in, just think about the environment for these various factors here. So what factors did well in the global financial crisis? Well, what did well is this one right here. What is that? Quality minus junk, right? In bad times, quality will outperform the bad stuff. Now, how could it go up so much in a market that was declining? Because these are long, short portfolios. You go long quality and short junk, right? So notice when things got better, well, it didn't do as well, right? We had a reversal here, right? So the quality asset, once we got the market bottomed in March of 09, didn't do well. Notice what also did well. Whoops, there's something about me touching that. Look what also did well. Momentum. Because the things that had done well, people were still buying, right? Then when everything, and the things that did horribly, no one wanted to own, right? So that did very well. But notice when the market bottomed, look how poorly this performed, right? So people need to understand each of the factors and what environments they tend to work in. So notice the slope of this line has been pretty consistent. You know, there's been a little aberration here. Been pretty consistent since the financial crisis, right? So the idea is that understand that none of these work together. That's why also when it does correlation matrices, you see they work in different environments. That's why I'm not an advocate of saying you should just live and die by one factor. If you can build a portfolio that can capitalize on multiple of these things, and again, if you like, let's say you like momentum better than you like small cap, you can always increase the weight a little bit. I did it for, I did equally weighted to illustrate the idea, one, and secondly, not interject my inherent bias into how one allocates. So you said geography. You know, the US market, these things tend to work well in. The emerging markets, the momentum works very well in, but you'll find that things that are accounting related tend to not do as well in emerging markets because they have not had the accounting standards that are the same as the US or let's say the developed world, right? When I talk about like Southeast Asia, if you're gonna go into Cambodia and be an investor, you're gonna be a little skeptical of the financials and the accounting data. And right, it just doesn't have that rigor that the US and let's say UK law tend to have. Now there's still fraud in the US, so nothing's perfect there. Capitalism will always elicit some fraud into it. However, I do see that geographically, momentum, it tends to be the most powerful of all these things. Momentum and lower volatility tend to be things that are extremely pervasive across asset classes, whether they're asset classes, also geographic diversification. And you know why that is? Or at least my contention is, I don't know exactly, but because those are human behaviors, right? Momentum is a human element, otherwise it wouldn't exist, right? There's no reason that the loser should continue to be the loser. Like some smart person to come in and take over that company, right? Same thing with the low vol. People want higher returns. They don't know how to use leverage or do that. Maybe we're learning that more these days, but that's part of the reason there. So I'll stop with that.
Okay, and actually that's a nice segue into the next question, I think. You mentioned there's no reason the loser should continue to be the loser. Growth factor has outperformed over the last several years to any other factor. This is the question already. How further could it go, and what do we need for value factor to be back?
That's the trillion dollar question, Joel. So if I had the answer, I would not tell any of you, and I would make a large bet on it. But knowing that we're just trying to play odds here, look, you can see that there are prolonged periods where the value factor did underperform. So notice here from 97 to almost 2001, the value factor underperformed. Only 4 years, but that drop was pretty precipitous. It's about as deep as this drop has been as of the last few years. So when I said losers, there's no reason for losers to be losers. I'm talking about momentum. I was not talking about the factor being a loser, right? So I was focusing on momentum when I said that. So that is a distinction there. But you know, look, it's also, you think about the environment, let's think about the COVID world. In the US, value stocks, like sectors that are typically value, are energy. Well, we all know what's happened in the energy complex over the last few years. In the US, we had our first negative price of oil one day, right near settlement, right? That was a short squeeze, that was a long squeeze on somebody. But we also know financials are in there. We have very low rates, a very flat yield curve. That's not conducive to financials as well. Also, we've made the financial system de-lever in the in the US in the global financial crisis. So, and we look at financials, there's something about the top 10 banks in the US versus the rest of them, because the top 10 tend to get bailed out too, where the rest of it is pretty poor performance, as they can't really compete on that magnitude. So there's something about the sectors that have driven that as well. And think about COVID right now. What has benefited the most? Technology. What are we using right now? Technology to all communicate. If it wasn't this post-COVID world, Joel, you and I would have flown down to the society and we'd have done this presentation in person. We saw some clients, we'd do some prospecting, we'd have used the airlines, we'd have used hotels, we'd use leisure, right? We'd have done all these things that the pre-COVID world looked like. So there's part of it too that I think it's been exacerbated by what's happened lately. And also remember in the US market, these are the largest companies in there. So what you do find is that the largest companies tend to, they will be large for a while, but they don't tend to be perpetually the largest companies. So that's because of competition and things come in there. So that's a long-winded way of saying, I don't know when value will come back, but you can still apply value. There's other ways of doing this. You can apply value with the momentum as well. So instead of taking those orthogonal portfolios, apply that screen in your screening. So give me cheap stocks that don't have bad momentum, right? So there's ways of interjecting these or combining these ideas to construct portfolios that may give you a better result. So I would say, don't give up on value. It's been something that's worked for a long time. Maybe we need to rethink our definitions of value, and that's up to the analyst out there to do that. And again, maybe price to or book to price, you know, these are kind of legacy assets that don't mean as much in this world. I mean, In the US now we're introducing this new earnings phrase called EBITDAC. So it's EBITDA with C on it. It's earnings before interest, taxes, depreciation, amortization, and COVID, right? So that's been introduced into the lexicon. So, you know, there was also like views back in the day. So we have to go back to what metrics represent valuation in companies. And so there's nothing that says you can't use price to enterprise value or something here. So perhaps that it's different ways to define it that will be, that give you different results.
Thank you, Sherman, for that. I have another question here. It says, what would you consider to be the most important downside of quantitative systematic investing? Is there a way to control for it?
Yeah, this is the whole debate between quants. Is it a purely quantitative strategy without human intervention? And then there's always the, well, we have a quant system, but we can override it, right? Right? Yeah. Or we can update the model, right? We update the model each time. And so there's dangers to both of those things, right? One is when I talk to investors, they like quant strategies, but they want someone to watch it, right? I've ran a few quantitative strategies, both at DoubleLine as well as before we joined DoubleLine in the commodity space. And I have never touched the models, right? I've never updated them because I believe in what they do. I've never updated the thinking behind them. We've ran them for 10 years and they do what they do. So there's something about that. Now, I think one of the biggest challenges of quants is the in sample versus out of sample, right? That people overfit data sets. So if I told you I was going to, for instance, in the commodity space, let's say I told you I was going to rebalance every 26 days and I was only going to use, I was going to be long 4 and short 6 commodities. I was going to do it in this exponential weighting scheme. Does that sound like something I thought of before I started looking at data, right? There should be a lot of flags that come up. Why this asymmetry? Why do you have longs versus shorts in a different combination? Why exponential versus arithmetic? Why did you pick 26 days? Why not 21? That's a calendar, right? So what you want to do is make sure that the data is not overfit to what you're looking, or the analysis isn't overfit to the data set. You see this in a lot of strategies, and that's where Wall Street was really criticized in the early 2000s. All the quant stuff, they give you great looking back tests, but they failed out of sample. We have one notorious out there that I love to show young quants when they come into DoubleLine. There was this idea of volatility harvesting that was done by Societe Generale. They sold it with a back test where it was like a 4 Sharpe ratio, it was doing 25% a year. The day they launched it, it never made another high water mark again. In fact, it plummeted and lost like 90% over the next 3 years. So it's an example where they obviously overfit the data set to what they were looking at. So that's a bigger challenge that, you know, young quants need to notice, especially you need some real world. What happens when you start putting capital into them? I think these are the challenges people have out there. And again, you're eager, you have the strategy, you want to run it, but you need time. Time's the only thing that gives you the out of sample analysis. And so make sure that if you're, and in this instance, when I'm showing you here, when I showed you all these factors, I'm showing the end sample. So we can do a 1 year, we can do a 3 year. Look at how those coefficients move through time. And that's what a good quant will do, is really understand the behavior of that. And look, you've got to take some downside in these things. If you overfit, that means you're going to have a bad experience going forward because you picked the best series you can find. And I think those are some of the challenges I see out there with quantitative strategies. They're good, but again, then you get the guy that sits there behind the wheel, believes in the strategy, then has March 2020 happen, panics, redoes something, and then misses the reversal too. So that's also why the title, I say, is trying to stay the course.
Okay, thank you. 2 more, if you have the time.
Okay, go for it.
Fast, and in parentheses, robot trading impact the benefits of systematic investing now that it's become a more prevalent style of investing?
I mean, there's only one way to look at that, and that's compare pre-robots to robots, right? And so what you want to see, so let me ask you this, have robots changed the low vol premium? Sure doesn't look like it, right? Momentum, probably not. Have they influenced the market? Maybe, I don't know. But I think that the robots, they're a form of liquidity, and you just have to understand that there's going to be heavy activity in the morning trading and the afternoon. There's always been, if you look at time-weighted pricing throughout the day, volume Heavy volume comes in the first 30 minutes of trading and the last 30 minutes of trading in the US equity market. Been that way for long periods of time, it still is. With the invention of market on close, ETFs, and things where they try to track things, or at least tracker funds at first with mutual funds, it created more heavy flow on the back end. Now with ETFs having to be able to quote and update NAV every 10 seconds, it's in the market. So I think this brings up a better point, Joel, especially on quant stuff, is that are you trading end of day? So if you're using just closing prices, your assumption in your spreadsheet is that you are executing at the close every single day. All transactions are done there. So if that's the case, and you start doing your strategy, what I tell any quant or any rules-based investor, if you want to invest, be consistent, right? If you're going to choose, 10:30 Eastern to trade 10:30 Eastern every day. Don't update your model intraday and like have a difference in there. Be consistent. Another thing I teach my quants, do it daily, do it weekly, do it monthly, do it quarterly. See if there's robustness from the sampling period, right? So if your estimators are changing massively day to day and you get widely different portfolios, maybe your system isn't robust, right? Or maybe you should be trading more frequently. Another thing is, let's say you choose weekly. Well, then now what we'll do, so give me Friday trading, give me Thursday to Thursday trading, give me Wednesday to Wednesday. I should see consistency. Again, they're going to give you slightly different results, but I want to see a consistent process. So these are all things that you should learn doing quantitative investing, is make sure that you have these sanity checks, because there's nothing worse than just falling in love with something because it's the best one out there, right? And you want to make sure that, so the way I like to show this to young analysts is that, okay, just do a random walk, right? You can do random walks. And then what you can also do is calculate the growth rate of these strategies and the long-term growth rate and the standard deviation bands. And then do it for short periods, do it for intermediate periods, and do it for the whole period. And what you'll see is that when you overfit data, you tend to select things at the high extreme of the standard deviation band. You picked what tended to be the best. So if you do that and you have a strategy, let's say that has a long-term return of 5%, but the one you've overfit shows 8%, well, that means you need to glean back that 3% per annum for a long period of time to catch up, right? So anyway, those are things, tricks that you can use at least to try to have robustness. And then again, go back and sample your data set. Try to change up the order of returns. If you can do what we call bootstrapping there, if you can go back and do that, some of those things will be very helpful.
Great. Okay. Thank you, Sherman. While you were talking, we got two more, but we'll see
Okay.
on your timing. First one is, there's plenty of smart beta products out there. What would you recommend an investor to look at when assessing the right one?
It's exactly the analysis I showed you here. I'd look at the factors. I would look at them in sample of those strategies. I do this table that we see here. Show me what you give me. Is there any intercept left after that? So if not, go to the cheapest one that gives you like this exposure. If you want if you want exposure to all these factors plus the market, this is a good solution. I don't know what it costs. I don't know how cheap it is, but if there's a cheaper version, that's the goal, if it's giving you identical exposure. But if you can find someone that gives you all these exposures and gives you some alpha, well, now wait a second, that should be superior, right? So what you really need to do is look at it. And then again, this is just using, I believe we've used monthly data here. A lot of these time series are daily. You can use daily data. Also, look at them at different periods. Look at rolling windows. How do those exposures evolve? And what are you looking to achieve? And so these analyses. The good news about this data set, I have it down there in the footnotes. It's free. Go to AQR. You go to that website. You can download it. Ken French posted on the website. This is free data that's out there for the taking, at least for the U.S. market. There
is a free lunch out there after all.
Yeah, they may ask for your email address or something. I try to sign up for their research. They keep denying me. But anyway, I'm a big fan of their work and the stuff they publish. So.
The last one over here, and it seems to be referencing slide 15. It said, do you believe the massification of ETFs after the global financial crisis can partially explain the performance of the market versus the other models? That's the question.
Yeah, I think so. I think definitely so. And I think, you know, this just shows you can have long periods of time where not a lot happens. But also, like, if you can generate this positive rate of return here, again, using a broader set versus just the traditional stuff. Again, if I can add 145 basis points per annum over the S&P 500, that puts me in a top decile of managers, right? We know that, right? We know that from our performance of our fund, right? So just doing things like that, you know that that's enough of an edge to the market to get you significantly there. I think what's happened is that the ETFs and the prevalence of this and the prevalence of trading, the zero commissions in some cases the US, reduced fees, reducing share size due to the ETF or, you know, these new portfolios we see in the US where you can buy fractional shares. I think that's encouraged more people to speculate, and they're going to speculate in momentum. Right. And I think that's part of what's happened. And, you know, there's been a lot of people scratching their head on why the stock market in the US do so well, given that we're still mired in a crisis. We still have economic overhang. How is the stock market back, you know, up for the year practically? And the NASDAQ was up 9 days in a row before today. And the answer that a lot of people put out is that a lot of people are actually not watching sports. You know, they've been given money, they've been given trading aspects. And so they've opened accounts, and this fractional share trading has helped them do it. And so they tell their friends about it. And if you look at the activity and ownership of some of these small retail accounts, they're in the most speculative type of names. They've done well. That's why companies like Hertz that filed bankruptcy, the stock like quadrupled. Because people that saw it, oh, they think American Airlines is bankrupt, and the stock goes up. So they continue that trend. Never has a company in the history of the US that any of us know about has filed bankruptcy and then tried to do an equity offering, right? That's saying we're going to use these proceeds to pay the bondholders. The judge blocked it eventually. They let it go through, then they blocked it. But that was just going to be a complete fleecing of retail investors. So I think the idea is correct. But remember, if it's a market cap weighted ETF, it inherently has that momentum in there, and that has been pervasive for the many years. And as tech has become a bigger and bigger piece of our market, that's been the bigger piece, which has done very well. I mean, the tech sectors, you know, if you look at tech, it's up like 10, 12% year to date. So.
Thank you very much.
Thank you, everybody. Thanks for all your time. Thanks for your interest. You know, feel free to share the slides if you guys need them. Joel, you can send these to these folks. Absolutely. Nicholas, we appreciate you helping set that up as well. And I thank everyone for listening on this Wednesday evening. Thank you so much.
Thank you very much, Jeffrey. Thanks again. Thank you to the CFA Society for letting us do this. Thanks to Nicolas and team from HMC. The recording and slides will become available on HMC's and our website. Thank you very much.
Thank you very much, guys. Have a good day. Bye.
Bye-bye. Thank you.